I'd like to welcome everybody to the February 13th meeting of the Oklahoma City Post-Employment Benefits Trust. We'll call the meeting to order, and the first item is approval of the minutes from the December 12th, 2016 meeting. All in favor? Aye. Any opposed? Next item is presentation of the investment performance review for the period ended December 31st, 2016. Doug Anderson is here with ANCO.
Thank you, Mr. Chairman.
Oh, wait a minute. Before you go further.
Yes.
I already forgot what Bob asked me to do. Make sure if you're going to make any comments or anything to use your mics and turn those on just so we have it recorded and we can get that in the minutes. Sorry about that, Doug.
No, it's quite all right, quite all right. In front of you, you should have the December 31 report and also the January 31st. First, a little explanation. I think last year I told you that the name would be changing. It's a rebranding, as we say in the modern day. And the firm's name, although it's not immediately clear when you see the logo, it's ANCO Consulting, and it's really a concept. So if you see the line going out to the left from the @ or the ampersand, that's really the most important part, because that's where the client's name goes. That's where your name goes, and then it's ANCO. So the concept and the idea that I'd like to hopefully lodge in your brain is that a client always comes first. All of our clients always come first. We're a fiduciary without reservation for all of our clients. And the nice thing about this name is that it's pretty easy to remember and say. So from now on, ANCO it is, and it has nothing to do with my last name. Nothing whatsoever. I was just as shocked as surprised by it as everyone else, and it was an interesting day. If you want more information about it, the website is up, it's running, it's got a really nice video that if you have a few minutes to spare, to waste, that explains all of it from the very highest level of our organization.
Doug, I have one question. Your fiduciary position won't change despite what might happen at the federal level, is that correct?
Oh, absolutely not. Right. So at the DOL level, that's something top of mind. We've always been fiduciaries for all of our clients. We don't consider it education, we give advice. And that's really the pertinent factor when it comes to that. So as far as being a broker or an investment consultant who is a fiduciary, always been fiduciaries, and that's something that slowly some of our competitors are coming around to, but the issue you're talking about is having huge reverberations throughout the industry, and not only that, with the executive order saying that they need to re-examine it, it's sort of causing a backlash right now. So I'm glad to say we don't have to worry about it, right? It is a non-issue with us, and it always has been. Thank you. As far as the firm goes, this is a change in the name only. It is not a change in ownership. It is not a change in our tax ID. That seems to be the thing that triggers an issue like that. Although at the January retreat, it was also announced that we would have 5 new partners in our firm. So these are very long-term employees, and they go from the very highest level of the firm to some of the folks who do very day-to-day tasks. And I'm very happy to say that because ownership is broadening, and that's part of the initiative with the firm as well. We were named Bogdan Consulting for a long time, and that's after Joe Bogdan. Joe Bogdan stepped away in early 2015, and that's kind of what we're seeing now is the firm broadening out from a Florida-centric, one-person named shop into a multi-generational, national, and even international consulting firm. So very positive from my end. And while we're on the topic of positive, performance has been very, very good. As of December 31, as of January 31st, if we could just roll back the clock for the fiscal year from January to December, I think we'd even be happier than we are. But if you go to page 10, without spending any time on the market environment, shows the total fund 1-year return, 8.4%. That's very good considering where our actuarial assumption is. If you look at the following page, page 12 is a page, it's very simple, but it's also very powerful. If you look from 2009 to present, we went from right about $7.5 million all the way up to $42 million. And that's good, steady growth from contributions mostly, but also some from investment returns. And you'll see on the next page what the history is. Remember when we started, we had an asset allocation target that is about where we are today. But we were very deliberate about early days not risking the principal that had been allocated to this trust. In retrospect, we should have gone all in. Damn the torpedoes, let's go in. But I think that what we did was prudent in its own time, and that we were facing the potential for a financial calamity that we had no idea how long it would take to recover. So this is a picture of the history and some of the choices we made very early on with our eyes wide open, that we may be giving up some of the upside, but we want to protect the principle of this trust in its very earliest days. You'll see the allocation on page 14. Where we are today is a long-term allocation to equities, 60% to domestic equities, and about 10% to international equities. That is a portfolio that is built to generate capital appreciation over time, and now that we're sort of in our teenage years, as far as this plan goes, I think that's where we need to be, thinking very long-term, accepting short-term volatility, even if it's negative, and building this plan for this trust for the long term. You'll see on page 15 how the portfolio is diversified amongst managers, and you can see that this lineup looks quite a bit different than it did just 1 year ago. Vanguard 500 Index is our sole large cap domestic equity exposure. As we go down, you can see that we have mid-cap indexed, and we do have a variety of active managers as well, which started to perform nicely during the second half of last year. I like page 16 as well. It tells us where we started, where we ended, and paints a picture of what happened during the quarter. So at the total fund, we started with $41.7 or $0.8 million. There was, you see the contributions there. You can see the income, which was $273,000. And you can see capital appreciation of 68, leading to our final end of quarter. But what that total does sort of disguise is some of the underlying movements that we saw during the period. So we eliminated drive appreciation and folded those funds into the S&P 500. You can see that we also took money away from DoubleLine and Loomis Sales and we contributed to Hoisington, and that so far has been a negative decision. During the quarter, Hoisington did not perform well as interest rates rose post-election. But interest rates, the 30-year Treasury is still at about 3.02, so we're not that far from where we were a year ago. It's just that immediate post-election snapback was negative, and you can see that the return on the appreciation for Hoisington was our worst performer for the quarter. But this is also a fund that takes a very long view and does a number of things for the portfolio. It provides a nice amount of income compared to the other fixed income portfolios. And it also has a negative correlation with equities. During the inevitable drawdown of the equity market, which will happen, this portfolio will stabilize the entire trust by performing in the opposite direction. And as we go on to page 17, here's the performance for the year. Total fund was at 0.81 for the quarter, which was in the 40th or 39th percentile of the all public plans under $70 million. During the quarter. For the last 1 year, 8.42%, which ranked in the 15th percentile. Again, that's good, strong equity exposure, and our managers started to perform very well in the second half of the year. Now, you can see a pretty clear break here where we're showing, during the 3-year, where we experienced some substandard manager performance, and those managers have been replaced and the portfolio restructured. 5 years, 7.12. And the 7-year annualized rate of return is 6.36. So going down the quarter and the 1 year, you can see where performance has improved. Loomis Sales, which was really not good during 2015, turned in an 8.7% return for 2016, ranking the first percentile of its peer universe. DoubleLine was up 4.5% in the 8th percentile. And then Lord Abbett High Yield, the very aggressive credit manager, was up 16.06, which is a remarkable return for a fixed income portfolio, especially in the late stages of an economic expansion. You can see Hoisington was barely positive for the year, although their quarter they were down 14.7%. Interest rates spiked as quickly as we've ever seen them. Their stance is to be very long-term oriented and predicting the direction of interest rates. Short term, you can see this result from them. Intra-year, about every 3 years, and again, talking with them nearly on a weekly basis to understand what their economic mindset is, which is if everyone else in the world is extremely enthusiastic, if everyone else in the world thinks that growth is magically going to take a different trajectory just because of the result of an election, they're not looking at the fundamentals of the economy. So they are staying with their long-duration pose. And if they do see inflation coming into the economy, they will change the portfolio structure dramatically from being long duration to very short duration, which should be very helpful at that time. You'll see our index fund is tracking perfectly. It's indexed, so it's underperforming by a small amount, which is the amount of fees. You'll see our mid-cap index is tracking its index very closely as well. Hotchkiss & Wiley performed nicely during the quarter, up 12% for the quarter, second percentile rank. For the trailing year, 21%, and ranked in the 21st percentile. Again, they were early to the financials and the energy spaces, and that's what drove the performance during the fourth quarter. Stevens, our small cap manager, continues to perform 10% for the last year, but they're investing in higher quality portfolios. So they're investing in smaller growth companies that probably aren't as exciting as some of the technology and the biotechs, but put in more reliable growth over long periods of time. They're looking for strong growth from their underlying companies for the next 3 to 5 years, rather than who has the best trailing quarter. And then our Causeway International came back nicely during the quarter, 0.44 versus a loss of 68 for the benchmark. Any questions on any of those managers? The rest of the book shows you in significant detail the performance and structures of the individual portfolios versus peer universes, et cetera. I would like to, unless there are any individual questions about that, move to page 35 in the report. And this is a correlation matrix. The numbers are a little bit difficult to read, but by color coding, it shows you the correlation of these assets going back over the past 5 years. And high correlation can be good if that asset category is moving higher. A negative correlation is what you get, it's called a diversifying asset. So we have a lot of assets that are fairly closely correlated. By the color chart there, you can see 0.65, you can see even numbers higher than that, but we have one asset that is negatively correlated with the others, and that's Hoisington. And you can see that that can be versus Hotchkiss & Wiley, versus Causeway, versus our equity portfolios. It offers a very nice negative correlation. So that's something I wanted to show here. On page 36, you can see the fixed income sector weightings. Blue is government securities. Non-blue are credit or securitized or even municipal securities. And you'll notice that we have a very interesting combination here. Hoisington is all treasuries. Loomis Sales Bond is mostly corporate. Double Line at this time has 39% of the assets in mortgage backs. But we like their process because they are very forward-looking in their allocations. And then Lord Abbett is almost all corporate bonds, and those are rated below investment grade. So you put it all together, 30% in governments, 43% in corporates, 16% in securitized, which we'll just call those mortgage backs, a tiny sliver in municipals, and there even is some in cash, which is a tactical asset for fixed income managers. What we like about this structure is that 43% of the bonds are in corporates, and we think that that's an area where research can pay off, and the higher yields over market cycle can build additional return into the portfolios. The next page is the same idea, but for the equities, and you can see it's a pretty diversified portfolio as we go from left to right. Dreyfus appreciation will be off of this chart next time, but they were in here for part of the quarter, and that's why they're shown here. Hotchkiss & Wiley, you can see, is quite different from the small cap active portfolio. And when we put it all together, I know it's always a concern of whether we have excessive exposure to any industries, but being here in Oklahoma City, I think energy is one that we pay a lot of attention to. Composite level energy exposure of 8%, and compared to the S&P 500 or the market, that's 1% higher. Any questions about either of these pages? Page 38 is the status summary. I see no reason to change any of these. I know Hoisington's performance is a little bit tough to look at right now, but we think it's consistent with the role that they are supposed to play for the system. Otherwise, I see no reason to make any changes to the status here. And I like the fee summary on page 39. What this shows you is the expense ratios of the funds we're invested in, the category average, so 0.41 expense ratio on a weighted average basis. Category average is 0.66, so the difference is 26 basis point to the benefit of the trust. So better than one-third less than what the category average. And as fiduciaries, this is something that's important to notice because you are watching costs. We don't think that you're giving up any quality for being in these funds. There's very little research that indicates that investing in higher fee funds gets you anything of better quality. In fact, the opposite is usually suggested. So cheaper fees mean more money to invest and saving almost $95,000 per year versus the category average of all of these. And the following page shows you the asset allocation. The gray bars tell you the range by policy of where we can allocate these. You'll notice that some of those allocations are a little bit higher than average, but unless you see a red arrow there, it's not outside of policy. The policy for cash is 0, so any frictional cash in there will trigger the yellow or the red arrow to pop up. And then on the next page, we show the performance for all of the funds on periods longer than we have been invested in them for reference sake. So we show them for annualized periods as of December 31, and then we also show the individual years for each of the funds on page 42. So 8+% rate of return for the year. Portfolio is diversified, has a variety of risk exposures. Some of the active risk exposures, especially on the equity side, started to turn in the second half and most specifically in the fourth quarter. So happy to take any questions on the December 31 report.
I've got one. On the percentile ratings back towards the front of the book.
Yes.
Like if you look at Vanguard in the last quarter and year, it's like, I don't know, 94, 96, something like that. Mm-hmm. Does that get rated on all of the managers that are in that area, regardless of whether they're indexed or active? It's all investment managers. Okay.
Correct.
Okay.
And that paints a very interesting picture. Can I ask you to? I see you're looking at page 17, but if I could ask you to go all the way back to 42 and looking at well, it doesn't have the ranks on there. But what I can tell you is that it's cyclical. There are some periods of time that index works better. There's some times that active works better. In the large cap part of the world, more of the time indexes do very well. But remember, we had some periods of time on the mid cap where we're wondering what's going on here, and we allocated more to mid cap index fund, which perfectly okay with. But I do like to have some active exposure there. And on the small cap side, it's mostly active exposure there. I like that as well. Less efficient markets, more companies to cover, less research from Wall Street means you have a better chance to outperform over time. Now, it takes a while sometimes to see that outperformance come to the trust, but we think that if you have enough patience and you have the appetite, then you will be rewarded over time. It just takes a while sometimes.
Yeah. Doug, to that point, I've heard it speculated, and I'm interested in what your crystal ball says, that the new reality that we have in D.C. may favor active management over the advantage that passive has had in the recent decade or so. Your thoughts?
Sure. I read a lot of that. So not only do we have active management, we have passive management, and we have this sort of hybrid that's called factor-based investing right now that's sort of in that. And my crystal ball is not good. I do know that certain industries will probably be favored at the expense of others. I think that also means that certain companies will be favored at the expense of others. But I also know that when you get to the large cap part of the world, those companies are really smart and very adept at dealing with changes that are coming from Washington, D.C. Now, when it comes to the small cap part of the world, when it comes to mid caps, I think that you're probably going to see winners and losers in a way that we haven't seen. So not only, you have that, you have a change in regime, you have a change in this DOL rule that came out is pushing a lot of folks into index funds, right? Because as a fiduciary of a plan, how can you be called in a lawsuit as doing something wrong if you go in a low-cost index fund? So there's that, and then there's some of this ETFs, as the additional money go into these passively managed ETFs, and they kind of swing markets around a little bit more than we would hope to. So crystal ball says active management on the equity side should probably see a resurgence. I'm not 100% on that. I think on the large cap side, a passive vehicle is probably your most certain path to the best performance because it takes an awful lot of time, it takes a lot of effort, and it takes a lot of patience to get that manager who's going to perform reliably and consistently for you. So I like to have a little bit of both, except for in fixed income, which is not a market. Fixed income are sold, but bonds are sold by dealers, so there's no widespread price discovery in that part of the world. So I am very against passive management on the fixed income side. I like active management because I think it's consistently can pay off. Right? You see the same managers outperforming very frequently in fixed income, but if I were to show you the list of the best 5 large cap managers today, and you compare it to the best 5 last year, there's probably no overlap. That's a tough dot to keep chasing all the time. So let's take manager risk out of certain parts of the portfolio. And I say this today, I say this 5 years ago, I say it 5 years from today. Let's not spend a lot of time chasing 5 basis points of inconsistent outperformance on the large cap side and focus more on where our efforts and where our patience can be rewarded. But I think the index funds have performed better, much better than expected through the halfway point of last year. And looking at that and hearing all of my other clients say, well, we've got to go all passive right now, that was kind of a tough battle. I prefer a mix, right? I like low cost, I like accurate tracking of the marketplace, but I also like targeting a few managers who have skill, demonstrable skill, even if it's up and down, and put them together in a way that suits the portfolio. So it's a very rambling and long answer to your question, but my crystal balls are probably going to see some active management do better than it has in the last 5 years. I've seen this before. If you go back to the late 1990s, very difficult to outperform large caps with active management because there's about 5 companies that was most of the performance. But at that time, small cap and mid cap index management was not as prevalent as it is now. So, somewhat similar. But then we had a very long period of time that active management outperformed in some places. We could start with the value growth performance cycles as well, but value performed well last year, which generally helps active management. So don't put all your chips on one number, is I guess what I'm trying to say.
Are there any other questions? All right, thank you, Doug.
Actually, we have the 131 report.
Yes, that's the next item. So we'll have the next item we have then is receive the monthly performance for 12/31 and 1/31.
Okay. So taking a look at the other &Co branded document in front of you, you can see performance. Performance during January was generally positive, and one of the interesting things that we saw was international equities came around and outperformed domestic equities. If you look at page number 1 of your monthly report, you can see for the month up 1.86, for the quarter up 5.08. For the 1 year, we went from 8% to 15.57%. If we remember how bad January of last year was, that's the reason. January of 2016 was the worst first month of equity market performance in history, so we dropped 1 month off. and we put 1.86% return onto the result, and it almost doubles the return of the trust. Looking down at individual manager performance, Loomis very well. Looking at their trailing one-year result, 1402 versus 145. Again, they held some energy exposure in their fixed income portfolio. If you remember back, February of last year was when the energy market turned. The barrel price of oil started to go up, and we started to have more rationality in that market. And that performance of one-year return of 1402 was paid for by a tough year in 2015 with this manager, so it's not all for free. Double Line did very well, but their result pales in comparison with Loomis. Looking at Lord Abbott, 20.56 for a bond portfolio. Hoisington, you can see they had a slightly positive return for the month. They're down negative for the year, but again, this is one of our 3 core fixed income portfolios. Vanguard up 19.89, the mid-cap up 23.62, Hotchkiss up 34%. You'll see that Stevens did outperform for the month, 24.5% rate of return for the trailing year. And you're seeing Causeway 3.17 versus 291 for the benchmark. So good results. They're almost too good. I'm starting to be a little bit contrarian here. The rest of the world seems pretty excited. That's when I get generally fearful. So like to keep these results up, but we also remember that we need to buy into the cheap asset categories when we fund into the trust, and when we need to take money out of the trust, take it from the best performers.
Are there any other questions? All right. Thank you, Doug.
Thank you,
I would
Mr.
take a
Chairman.
motion then to receive the preliminary performance report for December 31st and January 31st.
Second.
All in favor?
Aye.
Any opposed? All right. Thanks, Doug.
Thank you, Mr. Chairman and trustees.
We don't have anything on item 5. On item 6 is a joint resolution authorizing the renewal of a modified administrative services agreement with Blue Cross and Blue Shield. This is a joint item with both the MFA, the city, and then with also the Opebt Trust.
Move the item.
Second.
All in favor?
Aye.
Any opposed? All right. Item 7 is approval by the Oklahoma City Municipal Facilities Authority, the City of Oklahoma City, and the Oklahoma City Post-Employment Benefits Trust, amending the definition of participant in the clinic service agreement for CARE ATC, and this was to add the retirees.
Actually, it's to add the Medicare-eligible
Medicare-eligible retirees.
So I'll move the item.
I'll second it with comment, if I may. I
Sure.
want to commend the city staff and Ms. Berry for orchestrating this. As I've expressed in the past, I like the idea that we now have equal access of all of our retirees to this benefit, which I think is an excellent program.
Great.
And the only other comment I have, Mr. Chair, is that at some point the trustees will need to look at reimbursing for that participation, the retiree participation.
And so the way we have it set right now, it doesn't show additional cost.
That's correct. There is no additional cost. What will happen is CARE ATC, the clinic operator, will track the Medicare retirees separately so that we can analyze utilization. And we'll bring that back at some point in the future. But as of right now, we don't anticipate there's going to be any additional cost to the city or
Okay.
the MFA.
And at that point, we could evaluate it based on the cost as to whether or
Absolutely.
not we're able to continue the service.
Absolutely.
Because the idea really is, I mean, as we talked about this, was it's a lower cost service for us, and it should reduce our insurance costs, or at least it reduced the growth in our insurance
Absolutely.
costs. And so that's really the goal overall, that we'd be able to achieve that. So,
And the only other thing I want to mention is there will be information that's being distributed to Medicare retirees. They will receive that in the mail about the clinic. The staff will also be hosting meetings for Medicare retirees, since this is a new option available that will be available to them effective March 1st. So information will be forthcoming. If you have any questions, feel free to contact city staff.
I've got a motion and a second. All in favor? Any opposed? Item passes. Item 8 is the acceptance of the interim financial statements for the 6 months ended December 31st, 2016. And Jake Siebenaller, I got it right this time. I think it's the first time I got it right on the first try. With the Accounting Services, will make the presentation.
Yes, thank you. Good morning. I just want to point out a couple things from our annual report, our quarterly report. We're going to start on page 3 of your packet. Currently, the trust is reporting a net position of $43.85 million. This is an increase of about $3.5 million over the prior year when our net position was $40.26 million. In comparison to the same time period for the prior year, contributions have decreased $1.53 million, net investments have increased $3.1 million, and deductions paid has increased $1.3 million. In the current year, the net position has gained $3.58 million, which is comparable to the same time frame last year when we had a net position increase of 3.57, so we're tracking pretty close to what we were in the prior year. Next, we want to flip back to page 10, which is in your notes section of the financial. In this section, we want to look at the money markets. It shows that we are reporting $2.28 million, and this is compared to prior year of $4.31 million, which is reported at the top of the following page. So new for our annual financial last year, we had to go through and insert these two charts. Basically just gives you more detail about the type of investments that we've got and kind of tracks them compared prior year versus current year. So it's a little more detailed than what we used to provide. It's something we had to do with one of the new GASBs that came across. The last thing we want to look at is on page 12, and this just shows our asset allocation guides. You can see that all of our allocations are falling within our desired ranges on those, and that they're tracking pretty close to what our target values are set at. Do you have any questions at this time?
Are there any questions? All right, I'd take a motion. All in favor? Any opposed? All right, thank you, Jake. Now if I can find my agenda. Last item that we have is the ratifying the claims listing. All in favor? Any opposed? Item passes. Are there any other reports or comments from trustees or staff? Anything else? With no other items here, then we are adjourned.